At Ground Truth, we take a money strategy the internet loves, the kind that fills your feed, and test it against 6 years of real prices and real trading costs, the way a trading desk would, to see if it actually beats just holding and doing nothing. Not opinions. Receipts. Today's strategy is one you've almost certainly been pitched, earning weekly income from stocks you already own. If you own a few index funds, and that number just made you wonder whether you're leaving free money on the table every single week, good. You already did the math on your own balance, so did we. This is the most popular way everyday investors get told they can earn income from stocks they already own. It's called selling covered calls. And we spent 6 years checking if it's real. Short version, the income is real. But to collect $327 of it, you quietly handed back $429 of your own gains. There is one honest use for this trade buried in here. It just isn't income. So, 3 questions. Keep them. Is this income real? If it's real, where does it come from, and what does it quietly cost? Answer those 3, and you've answered the only one that actually matters to you, should this go anywhere near your money. This is Ground Truth. Here's what happened. Start with the pitch, at full volume. Because the strongest version of an idea is the only one worth testing. Quick note. This is education and entertainment, not advice. We test ideas. We don't tell you what to do. You already own the shares. You're just getting paid to wait. It's free money. It's rent. It's a paycheck. The market mails you every Friday. And here's the uncomfortable part. He's not wrong. A pro with 25 years in options will give you a handful of lessons, and every one of them is true. But before we can test any of it, slow down. Because this only works if you can actually see the trade. Here's the whole thing in one picture. You own a stock. You sell something called a call, which is really just a promise. If your stock climbs past a certain price this week, you'll hand it over at that price. In exchange, a stranger pays you cash today. That cash is the premium. That's your income. And that certain price you promised is a ceiling. You keep everything below it. You give away everything above it. That is a covered call. That's the whole trade. Now the pro's lessons make sense. Time is on the seller's side. An option loses a little value every day, like a coupon creeping toward its expiration, and the seller pockets that. And most weeks, the stock doesn't blow past your ceiling, so most weeks you win a little, both true. That's why the pitch is so convincing. It isn't a lie, it's a stack of true things, aimed at one wrong conclusion. So here's the real question, and almost nobody asks it. Not does it pay, it pays. The question is, does it beat just owning the stock and doing nothing? Run it once, you sell one weekly call, the stock jumps 2%. You keep your little premium, and you watch the rest of that jump walk straight out the door, above the ceiling you just sold. You kept the whole basement, and you sold the ceiling. So, we tested it properly. 3 ways: the version you get pitched, the pro's fix for it, and the opposite bet entirely. 1 bar, written down before we pulled a single price, beat just holding the shares. Now, before the results. This is the whole difference between us and a guy with a screenshot. Real, survivorship-free prices, at the bid. The price your account actually fills at, not the pretty one the calculators assume. Every week, 6 years, thousands of trades, and the pass mark sealed before we ran it, so we couldn't move the goalposts. And yes, these 6 years were a bull market, which sounds unfair until you notice it's exactly where the pitch lives. Nobody sells covered call income for the crash. They sell it now in a rising market. So we tested it right where it's advertised, and even there, watch what happens. Door 1. Sell a call every week, sealing right at today's price, exactly like the pitch. 6 years on the NASDAQ, a fund a lot of you actually own. The strategy made 104%. Just holding the same shares made 194. Holding won by 90 points. And on a hot, volatile stock the pitch loves, the strategy collected 2.39% a week, exactly the promised number, and still finished 45 points behind just holding. The income showed up. It just wasn't yours to keep, so the naive version's out. 1 door closed, but the pro has a fix. Okay, but you're doing it wrong. You don't sell every week. You only sell when the premium is fat. Sell the volatility. Fair. And true. Volatility just means how wildly a stock swings around. When it's swinging hard, nervous people pay more for those promises, so the premium gets fatter. His fix: don't sell every week. Only sell in the wildest weeks, when you're paid the most. So we did exactly that, only the wildest one in 4 weeks. And he's right. It got better. Every single time. That was the good news. But better and beats holding are 2 different sentences. It's still lost. One version squeaked ahead by 14 points on top of a 700-point return. Run 4 versions, and by pure luck, one comes out a hair ahead. That's this one. It's a coin flip, not an edge. We don't get to keep it. 2 doors closed. Which raised a better question than the pros. What if this whole family of trades is just betting on the wrong side? Door 3. Instead of selling the upside, we sold the downside. And slow down for 1 second, because this is the single most interesting finding in the whole video. Selling a put is selling crash insurance. You collect cash from people who are scared their stock will fall, and people overpay for fear. So the seller of that fear actually has a small, real edge. On the index, that side makes money right where the call side bleeds it. The put seller nets 42 cents a week, where the call seller loses 72 cents. A real edge. And it's still lost to just holding. 6 times out of 6. Because a stream with no upside can never catch a market that has one. 3 doors. 3 different ways to lose. Now, the one number that explains all of them. Remember the 3 questions? Is it real? Where is it from? What does it cost? Here's the number that answers all 3 at once. And it's about your account, not a spreadsheet. Over 6 years, per share, this strategy paid you $327, real money, in your pocket. But to collect it, you gave away $429 of gains on shares you actually owned, handed to a stranger for a coupon, and you were the last one to notice. $327 of income to give up $429 you already had. The yield was just the sound of your own money leaving. So how does the pitch turn a losing trade into 2 to 3% a week? Slow down. This is the trick. They annualize it, take 1 good week and multiply it out to a whole year, like turning 1 lucky paycheck into a salary. But they only ever multiply the good weeks. The weeks the stock ran and you got capped, the weeks it crashed and you ate the whole drop, those never make it into the math. Count those too, and the giant number vanishes. It only ever lived on a spreadsheet. We wrote the pass mark down before we ran a single test. All 6 versions, the 3 doors, each tried 2 ways, had to beat just holding the shares. Even 1 would count. It went 0 for 6. That part is measured. Here's the part we have to reason out. The why. Is the income real? Yes, every week you can watch it land. Where does it come from? It's your own future gains sold back to you at a discount. And what does it quietly cost? $327 collected to give away $429. It didn't die of a scam. It died of arithmetic. And here's why it fools smart people. It pays out small and often, so it feels like income. Then it takes it all back on the 1 week you'll remember for years. And you never connect the loss to the little payouts because they wear different names. One is called income, the other is called a bad week. A losing week just never becomes a video. And to be fair to the pros who teach this, their lessons are real, and they almost certainly run it themselves. They're not lying to you. But the people this quietly failed mostly went quiet and quit, so the record everyone sees is built only out of the winners. So carry 1 question out the door for the next pitch too. Is the person selling you a method actually rich from that method, or rich from selling it? So, should you sell covered calls on the funds you own for income? Before I answer, the fair objection, the one a smart defender makes, covered calls were never meant to beat the market. They're for income and a smoother ride. Take both halves seriously. The income you already saw, $327, that cost you $429, real cash, and it's your own money coming back. That half doesn't hold. The smoother ride is real. It's the one honest use, and I'll show you in a second. But as the weekly paycheck it's advertised as across 6 years of real prices, no, it isn't a scam and it isn't nothing. The honest answer is that it's complicated. It's real income that costs you more than it pays. Your covered call isn't printing money, it's selling your ceiling and calling the check a yield. And that smoother ride I promised you? Here it is, the one honest use in the whole trade. Remember the version we threw out as a coin flip? Its returns were luck. But look what it did to the losses. Sold only in those wildest weeks, on a genuinely jumpy stock, the premium stopped pretending to be a paycheck and became something honest, a seatbelt. In that stock's worst stretch, it fell 90% from its high. With the calls sold against it, it only fell 69. Same crash, softer landing. That's real, it's just not the thing on the thumbnail. And what would change our mind? A long, ugly bear market, a market that mostly falls, is the one climate that would actually make this trade look good. And it's the one thing 6 years of a rising market can't show us. We wrote that test down. The day covered call income beats simply holding through a real crash, you'll hear it here first. Until then, it's 6 for 6, and the ceiling stays sold. This is ground truth. We take the promise, your feed sells the hardest, and we test it the way a trading desk would. Real prices, real costs, the pass mark written down before the data. And we show the work, because a verdict you can't check is just another opinion. Next time, we put the internet's single favorite day trade through the same machine. 244,000 trades. The machine is always hungry.